I'm Emma Rappaport. Welcome to Morningstar. I'm here today with our Director of Equity Research, Johannes Faul, to talk about one of the most exciting and most talked about stocks on the ASX 200 this year, Westfarmers. Johannes, thank you very much for joining us.
Hi Emma, thanks for having me.
Bunnings really this year has really captured the public imagination. We've seen these big lines outside Bunnings. We've seen people just rush to DIY their homes and their gardens. And then we also saw Bunnings staff really being on the front line, talking to people about the pandemic, and they've really been out there. Do those numbers, do those amount of people lining up, do those trends really bear out in the numbers for Bunnings this year? And has the pandemic really allowed them to capture additional market share?
Absolutely. I think your observations you've made are reflected in the numbers when we think about sales growth. And Bunnings has had an amazing run. And if you think about what's been happening in retail, there's a few categories that have really benefited from COVID. I'd call them, the COVID beneficiaries. And that's first and foremost liquor. And I think that's probably intuitive given that pubs and restaurants are closed. People are buying their booze in store. And then it's pretty much sporting goods, toys, and hardware. And those categories have done the best since COVID has broken out. But I think one important thing to remember is this is a one-off, this is a windfall, and in our minds, it's unsustainable to have these strong sales continuing.
So you ultimately think that these trends won't last for Bunnings?
Absolutely. So what we think is clearly we've seen the proof of what you've been observing, what many people have been observing. This Bunnings has been doing very well through this pandemic, but we do see their sales growth to taper off and moderate towards where we think is the long-term trend.
So you see a challenging period coming up, but in your latest special report, which Morningstar Premium subscribers can go and have a look at, you have increased your forecast for Bunnings, you have increased the fair value. So you do ultimately see Bunnings as doing well, but maybe not as well as the share price implies at the moment.
Absolutely. So having said all that, Bunnings is an amazing business. It's by far the market leader in home improvement in Australia. And it underpins the wide economic moat we see that Westfarmers has. And it ticks all the boxes. The concern that we have is that it's overpriced, that there's too much upside baked in. We did a very detailed analysis on where Bunnings can grow its market share to. If we look at the categories where they're underpenetrated, so about a quarter of that home improvement market, they have less share than they have on average in the other categories. And we see them gaining more market share on those and growing ahead of the market. Despite all that, we still see shares as overvalued. And again, the market is implying either continuation of very, very strong sales or an marketable increase in profitability. And that would put Bunnings way off the chart if you compare it to international peers, let's say Home Depot in the US or Lowe's, which is also US listed.
So we're focused a lot on Bunnings, but Westfarmers isn't just Bunnings, it's Kmart, it's Catch, it was Target. How's the rest of the business going? Has it done as well as Bunnings has done over the last 6 months?
Westfarmers is a conglomerate. It has many, many businesses. Most of its value is derived from its retailing business. And as you pointed out, it includes Kmart, Target, Catch Group. Catch Group has been an amazing acquisition. That's a pure online player, and it's been growing at mind-boggling rates, triple digit we're talking. And then there's also Officeworks, and I think Officeworks, similar to Bunnings, has had a very successful period, and purple patch if you like. And the issue there though is that it's such a small part of the total corporation that it almost gets lost in terms of its contributions to earnings. So really the key driver for Bunnings value and therefore shareholders returns is Bunnings, and then that's followed by the Kmart Group. It's and you pointed out, there's challenges there with Target, with them shuttering a raft of Target stores, converting some into Kmart, and then there's, in our minds, still question marks around what's going to remain with that stomp, with that residual Target business. Is that still going to be around in 10 years' time?
Right, and Catch's nearest competitor would be someone like Kogan, which has done well this year, but where does Catch sit against Kogan?
It's interesting. So Catch, on our numbers, has been outperforming Kogan, very closely with Kogan, but slightly outperformed Kogan. And that's probably another piece of proof that these retailers are doing well because their categories are doing well. It's not their business strategies or they have a particular edge on others. It's just that online in this current environment during the pandemic has done very, very well for obvious reasons. And we expect online to continue to do well due to structural reasons, which it has been doing for the last 10 years. But I think that pointing towards business out of context and just looking at the growth rates is probably prone to a bit of error. Looking at it more holistically and seeing what the competitors are doing, that would help investors to get a bit more of a feel of why some businesses are doing that well. And then also maybe taking a step back and asking themselves, like, why are these businesses flying at the moment, and is that sustainable? And to wrap things up, I would really say that our concern lies within the strong growth, within this COVID windfall for these COVID beneficiaries not to be sustainable. And I think that's where we differ to the market.
Great. Okay, so that was just a taste of what's to come in your special report, which is up on Morningstar Premium. It's excellent. I've read it, so I encourage everyone else to go read it. Thank you very much for joining us today.
Thank you.
Any advice in this video is general advice prepared by Morningstar without reference to your financial objectives, situation, or needs. You should consider the advice in light of these matters and any relevant product disclosure statement before making any decision to invest.